Let's see. Now we'll try to understand the accelerated depreciation method. Otherwise, it may be double declining method or triple declining method. Assume an example here. The original cost of an asset being 1 lakh and then the rate of depreciation for that asset being 10%. And method of depreciation being straight line method of depreciation. We have straight line method of depreciation. Is that okay? So we now try to find out the depreciation for the first 3 years in general. Okay. Original value or original cost at 0th period, the asset being 1 lakh. Depreciation for the first year at the rate of 10% being 10,000 rupees. And WDV by the end of first year 90 minus depreciation for the second year, as the rate of depreciation 10% will be calculated, means as it's being SLM method, the rate of 10% will be applied on 1 lakh. So for 1 lakh you can calculate 10%, which is 10,000 rupees. So from 90, if you subtract the 10,000, now it is 80, which is the WDV by the end of second year. WDV by the end of second year. Again, provide the depreciation for the third year. Also 10,000 rupees. Then 70,000 rupees is the WDV for the third year. Clear? Hope so you could understand. Let's move on to double declining method. See, when we expect about the life of the asset, probably they will say it may be for 10 years. As they say it may be for 10 years, life of the asset being 10 years. Then what I do? Original value of the asset being 1 lakh, we assume that scrap value being 0. It means the depreciation, amount of depreciation is equal to 1 lakh minus scrap value divided by 10 years is equal to 10,000. Or the rate of depreciation being amount of depreciation divided by original cost in percentage. The depreciation here being 10,000, the original cost is 1 lakh. If you represent in percentage, this is equal to 10%. This is equal to 10%. Is that okay? Clear? And as per that provisions, year on year you have to provide the depreciation 10,000 rupees. Matter of 10 years later, it will be totally washed out. We don't have any more. But surprisingly, sometimes depreciation may be higher than the expected one, not 10%, it may be 15 or 20 also. On investigation, we came to know the technical specification given by the seller of the asset is this asset will work for 10 years provided you need to work it for 8 hours a day. 8 hours a day. But what happens now in this scenario, they have doubled the working hours, 16 hours a day. Double shift. There may be possible some company will work for double shift. So in the case of double shift, we will not guarantee that the asset will come for 10 years. It will be reduced proportionately. Now the hours taken for consuming or working in this machine is 2 times of the existing one. Then the rate of depreciation should also be 2 times of that 10%. So now the revised rate of depreciation being 10% multiplied with the number of times it's inflated. So 2 times. So 20% will be applicable, not 10%. If you could have used it for 8 hours, okay, I'll assure that this asset will come for 10 hours, 10 years. But you used 2 shift every day 16 hours, double the performance. So if you are doubling the usage, then definitely it will be depreciating faster than the expected one, accelerated. The depreciation is at the accelerated rate. So I am accelerating, right? So here the original cost being 1 lakh minus depreciation for the first year It's not at the rate of 10, it's 20% rate will be taken. So first year depreciation being 20,000 and now the WDV being 80,000 rupees. 80,000 rupees. Then depreciation for the second year, again calculate the same way. 20% on the original cost of rupees 1 lakh, this value being 20,000. If I subtract, then the WDV here being 60. And third year the depreciation could be again for 20,000 rupees on the original value. So the WDV by the time is equivalent to third year being 40. This is called accelerated. Sometimes they have not only doubled, they have worked for almost 20 hours a day. We thought 8 hours a day you will work, but they have worked for 20 hours. 20 hours means 20 by 8. Almost 2.5 times you have accelerated. Send it 2.5 times. 8 hours, another 8 hours, another half of the normal expected working capacity. So 2.5 times. By the time the rate of depreciation will be inflated to that extent, so 10 into 2.5 is equal to 25% will be the rate of depreciation. Now original cost of the asset being 1 lakh. Now the depreciation for the first year being 25% on this 25,000 and the WDV by the end of first year will be 75,000 minus depreciation for the second year again 25,000 and WDV here being 50,000 and from there depreciation being 25,000 on that. So balance being final WDV 25,000. Is that okay? This is called accelerated. In general, all these category will be named as accelerated. If you are doubling your usage, then it is called double declining method. If you are tripling it, then it is called triple declining method. Here I have given an example for double declining method. It's not triple, but it's anywhere between double and triple. 2.5 times of the depreciation rate is used also. So from this, it is very clear. Accelerated is nothing but you are going to use the assets more than the normal usage. In that case, you are going to raise the depreciation proportionately. This will be not only applicable for the SLM, it may be applicable for the WDV method also. Is that clear? Come on, make a note of it.